right, good morning. It's 7 minutes after 10. That means it's time for the Real Estate Fix with Rich Sherman. I'm your host, Rich Sherman, on a KHTS 98.1 AM 1220, your hometown station. Thank you guys for tuning in this week. We got a big show this week. We're going to do a little bit of a market wrap-up, as we always do. I like to do a little market minute segment to start off the show. And we're going to get real heavy into reverse mortgages because I've been seeing some stuff in my office that, frankly, has been terrifying me because I consider it my duty to use my platform, as I have one, to educate you guys, let you know what's going on. And I have seen what I can only describe as a scam, a con, a grift in the reverse mortgage industry that is unbelievably commonplace. And it's perpetrated by I think it's a lot of the banks do it, but the two worst offenders are for sure Carrington Bank and PHH. They're two of the biggest banks in the field, and what they're doing is frankly unconscionable. What I've said publicly, and I will say again, is both of those entities apparently have a business model that allows them to steal from the elderly and then torture them. So PHH and Carrington, and I absolutely stand by this, are both stealing from and torturing little old ladies. And when I say stealing from, they do that by charging fees that they should not otherwise charge, but it's a reverse mortgage and you're dealing with a population that is elderly, so they are vulnerable. Then you don't tell them what you're charging them for, you just say it's reverse mortgage stuff. And what you do is you wind up generating about $5,000 to $10,000 additional profit on every one of these loans, and nobody is the wiser. Because when somebody has a reverse mortgage passes away, the family just goes, oh, well, he or she had a reverse mortgage, and they just pay it, and that's kind of that. They pay it off with the house, and that's kind of that. So they don't understand that they've been conned, and even if they had been, you wouldn't know because you'd have to look at the details to find out. And then we'll talk about how they have bury codes and things like that. We've talked about that as well before. So we're going to get into that. We have a very special guest. My wife, Jane, is in because she's the real estate attorney, and she's the brains of the operation. So she's coming in to the booth today to have a long conversation with us about reverse mortgages. We've been a heck of a week studying on these things because the more you learn, I mean, I know about reverse mortgages, I know the surface level stuff, but the more you dive into it, frankly, the more terrifying it gets. Reverse mortgages are a problem and a half, and that is why some of the big banks have gotten out of it, and why you're seeing these guys with really bad reputations getting in it. We'll get into that a little bit later in the show. But first, we want to start off with kind of the market. The market hasn't done a whole lot this week. It kind of moved sideways, kind of a lateral move this week. I'll just read you what CR, the California Association of Realtors, put out this week, which is nice, although I should have blown up the text. But anyway, because I'm old. Anyway, okay, let's see. Tightened supplies continues to put a drag on the market, resulting in fewer sales, high home prices, low housing affordability. Again, there's that word again of housing affordability. Affordability. That's going to be the buzzword for the next couple of years. With rates remaining high relative to levels observed between 2010 and 2021, housing inventory in the resale market will remain low as long as the lock-in effect continues to prevent potential home millers from selling and putting their homes on the market. The lock-in effect, what they're talking about there, is the 70% of mortgages in the United States right now that are currently below 4% in interest. And because there's 70% of those people who have interest rates below 4% and the current going rate is about 6.5%, that's leading to a lot of people who are not putting their houses on the market. I've used myself as an example over and over again. I am, demographically speaking, I am the perfect guy. My wife and I, we should be selling our house now because our daughter's about to graduate from high school and buying the next house. But we're not going to do that because even downsizing, our mortgage would still go up dramatically because we'd be going from a sub 4% interest rate to a 6.5% interest rate, and our payment would essentially double. It's ridiculous. So you're seeing a lot of that. So that's what they're talking about when they talk the lock-in effect. Anyway, meanwhile, the housing supply shortage creates an opportunity for developers and residential construction, which has been rising in recent months. As a result, despite more new homes being built for the first half of the year, the increase in home building activity on the national level has not led to a significant improvement in California housing supply, and the constraint will likely remain in the short term. Really what's happening is it's become much more attractive for builders to build because houses prices are up suddenly a little bit compared to January of this year, for example. Still down overall from its peak in April of last year, but it has bounced up. There's been a little bit of a bounce back, and as a result, and because it's tight in supply, builders are doing well. But unfortunately in California, because of the way builders build in California, because of what they have to go through to build in California, the regulations and such that slow things down in this state, which I don't think is good or bad, it just is. They're not bringing stuff online as quickly as they'd like. So builders are all kind of rushing right now to get as much stuff on the market, built in on the market as they possibly can, because they, like I know, that these times are not going to last. This little bump we've had, I don't think it's going to be up. But let's see. Here's what I'll say. Supply drops after a brief bounce back in April. Housing supply tightened up again as mortgage rates stayed elevated and potential home sellers remained on the sidelines. The statewide new active listings for existing single-family homes remain nearly 30% below the 12-month level in May. While new active listings added in May jumped 19% from April, They're up 19% month over month from April to May, which is good. The number of properties added to the market last month continued to trail behind last May by double digits. Assuming the softer sales levels in June, the unsold inventory index at the state level could see a minor improvement in the upcoming month, but the upward adjustment would be entirely due to a change in demand rather than a change on the supply side. So what they're saying is if the demand slows down a little, which I don't think is going to happen unless interest rates go up even more, which they may, and I think they will a little bit before they come back down, again, the market is shrinking. The entire market has shrunk to the tune of about 40% in our area. There are 40% fewer homes coming on the market, 40% fewer homes being sold, 40% fewer mortgages being taken out. And so it's where the entire market is shrinking. And there's a race to the bottom between supply and demand because supply and demand dictates what prices are. And right now it's very simple. Supply is going down and demand is going down, but supply is going down faster than demand. And that is what's creating a house spike on the West and East Coast. The middle of the country is not really seeing a lot of this, and Florida's not. But let's see. So central bank's decision put upward pressure on rates. Mortgage rates have been moving mostly sideways in the past few weeks after reaching a peak in early May, June. The Fed's announcement of 2 more rate hikes before the end of the year. By the way, I think we talked about this a couple weeks ago. I said there were going to be 2 more rate hikes before the end of the year. Now the Fed has come out and said, hey, Rich is right. Well, they didn't say Rich is right, but let's just say I paid attention. I was right. Anyway, coupled with recent decisions to raise rates by other central banks around the world has kept interest rates from falling much since the beginning of the month, with inflation expected to ease further before the end of the year, though mortgage rates will likely decline in the second half of 2023. Let's hope they're right. A few housing experts, in fact, predict that the 30-year average fixed-rate mortgage could go down below 6% by the end of the year. I doubt that highly. I love the California Association of Realtors. I am a member. I have been for a long time. But it's their job to always see sort of the sunny side, and I appreciate that. I do not think interest rates are going to be down to 6% by the end of the year, but I'd like to be wrong. Heck, I'd like to see them down around 5 now. Actually, 5.5 seems to be the magic number. If the interest rate gets down below 5.5, the economy and the housing economy gets right back on track. Right now, we're about 6.5, so we need to lose about a point. So we'll see. But yeah, builders remain cautious. Building momentum has gained momentum in May, with housing starts surging more than 20% from April and rising 6% from the same month last year. However, the West was the only region with a month-to-month decline in housing starts. Building permits at the national level also increased moderately by 5.2% from April, but declined 12.7% from last May. So builders are trying to get them out there. They're trying to get them going, but they're just, it just takes time to ramp up when you've been ramping down, because I thought it was going to get a lot worse. They're ramping down construction. Now they're ramping it up. So we're trying to get moving. Last thing I want to add about the economy and about the sort of the market is that I keep hearing about how we're going into a recession, and I keep saying we are already in one. And to that end, and I just found this fascinating. There was a report recently in Forbes that says we are already in an earning recession. The profits for S&P 500 companies are estimated to have dropped 3.7% on average in the first quarter of 2023 compared to the first quarter of 2022. 78% of firms surpassed forecast, which is good, but it's less impressive than it sounds because given analysts had slashed their expectations before the season kicked off, it was the second straight quarter of earning declines for corporate America. So 78% above estimates, but still second quarter of declines. 7.3% is actually the slump that's estimated. A pinch from higher interest rates and wilting consumer demand will extend to the third quarter of 2023. Earning drops of more than 3/4 was last seen in 2015-16 when the Fed started raising its interest rates housing cycle. And that particular part was from Bloomberg. But anyway, yeah, we're already in a recession. Inflation has gone up, prices have gone up ridiculously. The interest rate was brought up to try to cool that. And when the Fed says they need to bring down inflation, they're talking about some of the bigger numbers are in housing. So that's what the Fed is after. I disagree with their goal, and I don't know why they need to get down to 2% as an acceptable inflation margin. I don't get that at all. I think that's way, way too low. But again, I am not on the Federal Board of Reserve, and they're not likely to ask me what their policy should be. It'd be nice if they did. I'd like to feel like I had a hand in that. I'd like to think I could help. But no, they're not going to ask me because I'm just not the guy they ask. Anyway. So that's the scoop there with the market. So basically sideways from last week. My advice stays the same. If you have a house to sell and you're planning on selling in the next year, get in the game now, because I'm very concerned where housing prices are going to be a year from now or even toward the end of this year versus where they're at now. We're in this great little bounce now, which I have a word for them, a term for them that I like to use, dead cat bounce. I'm not supposed to say that, but because I guess I overuse the term because I like it. But anyway, we're in a little bounce as far as the market is concerned and as far as housing goes. So if you're a seller, you're going to get about 3% more out of your house right now than you likely will get by the end of the year. And if you're a buyer, my advice, same thing. Get in the game, but find out what you're qualified for. Take a look at those loans. I was just discussing just before I came on the air with somebody that they've got a loan in a house that's sub 4, and they're looking at what they want to do with the house going forward. And the advice is keep the house, keep the loan. I mean, if you want to sell the house, keep it as a rental because you've got a sub-4 interest rate. And I don't think we're seeing those anytime soon. And that loan has a value in and of itself just because it's a nice low loan. It's a nice 30-year fix, so keep it. So that's my advice there. But if you're a buyer, get into it, find out what your options are, and you may find out that you're better off buying now than later because, again, as we just talked about, as I was projecting, the Fed just announced they're going to increase the interest rate 2 more times before the end of the year. Whether that has an effect on mortgage interest rates, a direct effect that is, raising them, we don't know. We'll have to see what happens in the stock market, bonds versus stocks. We've talked about that before. I mean, essentially what happens is money stays in the stock market, interest rates will go up. If the Fed raises interest rates and money runs into the bond market because investors are scared about the economy collapsing, interest rates go down. It's just that simple. So that's what to watch. The first thing is, what does the Fed say? Second thing is, how does the stock market react to what the Fed has said? And that'll determine interest rates. And everything tells me they're going to go up again by the end of the year. I hope this projection is correct and they go down, but I just don't see that happening. So let's get into reverse mortgages. Now we're done with kind of the market stuff. And as always, if you have any questions about any of this stuff, you want me to go over anything in more detail, just call me anytime. I'm happy to. You can reach me. I always give out my personal cell phone. I give it out on the air all the time. 661-714-1400. Again, this is my personal cell phone number. Just please don't call me while I'm on the air. 661-714-1400. You can text me while I'm on the air. That's fine. I'll be happy to answer your text as soon as I get off. But 661-714-1400. My name again is Rich Sherman. You can call me anytime I have answers to these questions. If I don't have answers, I will go find them for you. But let's talk about reverse mortgages. So I got a couple of really interesting pieces on reverse mortgages, starting with Representative Takano from Riverside. He wrote up, his office wrote up a great little piece on reverse mortgages. I'm going to read it to you now. This is one of the best definitions I've ever heard about a reverse mortgage. Reverse mortgages are loans that allow seniors to take equity out of their homes to help pay for living expenses or other costs. All right. As the equity in their home decreases, the amount of the loan increases. Unlike a traditional mortgage, seniors do not make monthly payments on reverse mortgages. However, the loan becomes due when the borrower dies, moves out of the house, fails to maintain the property. Here's where it gets sticky. Pay homeowners insurance and property taxes. This type of loan is almost always insured by the Federal Housing Administration. We've seen those commercials. They talk about it's federally insured. That's what they mean. As financial pressures on seniors have increased, the number of reverse mortgages have grown, and so have the opportunities for unscrupulous lenders to take advantage of seniors. Exactly what we're talking about today. These loans are complex, expensive, and drain equity from the property, leaving seniors with very few options later in life. Now, there's a couple of statistics I'm going to read you because they curled my hair when I saw them, and you need to pay attention to this. This is a big deal. 1 out of every 10 reverse mortgages is in default and could face foreclosure at some time during the life of the mortgage. I'm going to say that again. 10%, 1 out of every 10 reverse mortgages goes into default and could face foreclosure during the life of the mortgage. And you've got to immediately be asking yourself, well, how can a loan where I don't have to make payment go into default? So I want to go back over this. The loans are complex, they're expensive, they drain equity. The biggest reason that people go into quote unquote what the bank calls default, failure to maintain the property, which is a very nebulous term. What does maintain mean? Failure to pay homeowners insurance and property taxes, which, okay, you have to pay them, but I've got a lot of cases right now where they have been paid and the bank has said they haven't, so they put it into foreclosure. We're going to get into that later. So I have 2 cases in particular we're going to talk about as exemplars of what's going on in the market in general, because it's just wrong. Stealing from old people anybody is wrong, but stealing from the elderly is particularly wrong. Stealing from their retirement is particularly wrong. Taking advantage of somebody in that position is particularly wrong, from where I sit. But anyway, so yeah, 10% of them. Now, by comparison, the numbers for standard mortgages, the default rate on standard mortgages runs anywhere traditionally from 4 to 6%. It hovers at 5%. Just to give you some relevance here, in the mortgage crisis between 2008 and 2010, the default rate on mortgages in the United States got to 9.8%, and people were going nuts. The sky was falling. Prices had dropped by 50%. It was pandemonium. That was a 9.8% default rate. Yet with reverse mortgages, the standard is 10%. That's got to get your attention. Because what determines a default in a reverse mortgage is different in a lot of ways than what determines a default in a normal mortgage. And that causes problem after problem after problem. So with the decline in pensions, the economic recession, cost of living adjustments that don't keep pace with rising cost of healthcare and increasing life expectancy, it's encouraged seniors to seek alternatives to supplement their retirement. AARP did a fascinating study about this. They determined that 98% of seniors in the United States, 98% will need the equity in a home to be able to retire. I don't know who those other 2% are who don't need the equity. God bless them. But 98% of people will need the equity in their home to retire. And these reverse mortgages aren't necessarily bad products on their face. But what happens, we'll wrap up with this, we'll go to break, we'll bring Jane in. But what happens with the mortgage industry in general, and they do this over and over and over again, and they think themselves clever for doing it. They will find a little known, little used financial vehicle, whether it was interest-only loans or negative amortization loans, or now it's reverse mortgages, and they abuse it. They stretch it way beyond what was ever intended to be used. I mean, reverse mortgages should be about 0.01% of the population, I figure, of mortgages. And right now, they're about 0.05%. They're 0.5 of it, which still isn't a lot, but it's about 5 times more than should be out there, statistically speaking. And again, I'm not just down on reverse mortgages. I'm down on the misuse of them by the banks. So AARP determined that 98% of people need something in their house to be able to retire. There are other ways to get this money besides reverse mortgage. But people need this stuff to supplement their pensions. In 1980, here's a fun statistic. In 1983, 62% of private sector workers were covered by a defined benefit pension plan. 62% in 1983. By 2010, that number had dropped to just 19%. Want to take a guess as to what it is now? 6%. That means you spend your life working for a company. 6% of people who do that will have a pension. The other 94% will not. So that means they need the equity in their house to be able to survive, which gives rise to reverse mortgages, which gives rise to people who are desperate to get them, which gives rise to the banks behaving badly because they can. So we're going to talk about all that stuff when we bring Jane in. We're going to go over this stuff in some detail, hopefully not too much. And again, if you have questions about this after the show, just give me a call, 661-714-1400. I'll be happy to talk to you. But I tell you, let's go to break. Let's hear from some of our advertisers, and we'll bring Jane in and we'll get in deep into reverse mortgages and tell you what to look out for and how to protect yourself from these things. I'm Rich Sherman. You're listening to The Real Estate Fix with Rich on KHTS 98.1 FM, AM 1220. Come back after the break. We'll talk to Jane. Hello, welcome back. You're listening to The Real Estate Fix. I'm your host, Rich Sherman, on KHTS 98.1 FM, AM 1220, your hometown station. And we've been talking about reverse mortgages, and we have a special treat because we have my wife, Jane, in the booth with us today, who is real estate, in addition to being my wife. She's also a real estate attorney extraordinaire and definitely the brains of the operation. So we're going to talk a little bit more about reverse mortgages and the kind of stuff we see and how to kind of defend yourself, what to watch out for, how they work, that kind of thing. So thank you for coming in. I appreciate it. Thank you, honey, for being here.
Oh, sure thing. Good to be here.
Whenever I desperately need an answer to a legal question, I ask my wife because I'm lucky enough that I can do that. And for reasons I can't entirely explain, you take the time to answer me, which is weird. I would be much shorter with me when I ask these questions at this point in our life, but you're very nice about it, and I appreciate it. So before we get into reverse mortgages directly, I wanted to give a few more statistics. We talked about 10% of them are ripe for going into foreclosure and due. I want to talk about this one. This is also from the Congressman's office in Riverside. This is an example he gave. 68-year-old taking out a reverse mortgage on a house that's paid off with $250,000. So this is an older example because there's no house in Southern California that only is worth $250,000.
Yeah, I don't know.
But let's just use that, $250,000. Assume the borrower is approved for a lump sum payment. We'll talk about the 3 different types of ways you can take money out on a reverse mortgage in a minute. But let's say he does the lump sum auction for $135,000 with an interest rate of 4.99%. It's not a bad interest rate. After 10 years, the loan balance will grow to more than $250,000, nearly double. And after 20 years, the loan balance will more than triple to $450,000. So he borrows $135,000. After 10 years, again, he's not made a payment. He's reverse mortgage, took it out of a lump sum. He now owes $250,000. After 20 years, he owes $450,000. So aside from that being not the greatest deal I've ever heard of and destroying a generational wealth and all the other things that reverse mortgages, bad things they can do, they're just expensive. They're just expensive. They just are. They're just problematic. Let's talk a few other mortgage facts. According to HUD, in fiscal year 2021, California represented nearly 36% of all reverse mortgages. We have more of them here than any place else. The next biggest state was Florida with 6.19%, Texas with 4.07%, New York at 3.14%, Pennsylvania with 1%. Those 5 states, California, Florida, Texas, New York, and Pennsylvania, those 5 states represent 51% of all reverse mortgages. And California has 36% of those. Wow. So we are the big dog in the case of reverse mortgages because we got more of them than anybody else. So let's talk a little about reverse mortgages since we have Jane here and she knows a lot more about this stuff, which I think is fantastic. And then we'll get into Carrington and PHH and those people and their behavior. But so let's talk reverse mortgages. So first of all, who qualifies for a reverse mortgage? It's always the question we get first.
Well, for the most part, it's for homeowners that are 62 and older. It's designed for seniors. And that's the entire point of it. There are some proprietary and individual programs that will go a little bit lower than that. But generally, you have to be at least 62 and older for the government insured loans, which is the vast majority of reverse mortgages out there. And that's a large part of why I think this is a system that's taken advantage of by a lot of banks, because it's government insured, which means all they have to do is submit the paperwork to the insurer, the government, and they get paid every penny that they're due should the loan go into default or it become upside down and there's more owed on it than the house is worth. It's no longer matters.
So in short, what it means is the bank doing a reverse mortgage, this type of reverse mortgage, which is the vast majority, 99.8% of them in the United States, are what are called HECMs, home equity conversion mortgage, and those are federally insured through FHA. What that means is a bank cannot lose money on a reverse mortgage.
Basically, yeah. It's become a real profit center for those banks that do participate in it, because the fees aren't paid attention to, as you were mentioning too. The fees and the costs of this loan just get rolled into the balance. Nobody is sitting there writing a check. Nobody is making payments every month. Typically, you can make payments, but obviously very few people do because it's optional. So what happens is that amount just rolls up. Those fees get added. You pay a fee to process any paperwork. You have monthly fees for maintaining the loan and for them managing it, the bank, and these just roll up every single month. And on top of that, the interest rate, most of them have, if you can have either a fixed or adjustable rate interest rate, at different terms. We can get into that in a little bit, but if it's adjustable, it adjusts every month. So every month, if the interest rate is going up, like it has been recently, that interest rate is going up, which means it's compounding on the higher amount every single month. And every time you turn around, which is what gets you to the numbers you were just
And also,
mentioning.
listeners, keep in mind, when we say compounded, what it means is if you owed $5 last month, and then you owe $6 this month, and then you're being charged interest on the $6, not the $5, because the amount has gone up. So you pay interest on the amount that you owe, and that amount on a reverse mortgage goes up. Well, actually goes up every day, but it's calculated every month. So your interest rate is not just your interest rate, it's your interest rate compounding on the amount that you owe. So your effective interest rate actually gets higher. So yeah, most of the reverse mortgages you're going to see, any reverse mortgage you're going to be involved, they're going to be called HECMs.
I like the abbreviation of that. It's HECM.
Home equity conversion mortgages. And the reason for that, they're federally insured. That's good for the client, but it's also very good for the bank. And that's why, you really shouldn't be getting into ones that aren't that, because there are two other types of reverse mortgages, and I'm not even going to get into them at length because they're dangerous and terrifying, and they're a very bad idea.
Yeah, I would stay away. If for no other reason that they're not federally insured, I would absolutely.
All different rules. So stick with that. Yeah. So let's just talk about how insidious this has become. In fiscal year 2019, the National Reverse Mortgage Lenders Association tells us there were 31,274 reverse mortgages taken out. In 2020, that number jumped to 41,000, almost 42,000. 2021, that number jumped to 49,000. 2022, which last year we have decent numbers on, 64,000 mortgages, 64,489 reverse mortgages taken out in 2022. And in 2023, we are on pace to break 90,000. The absolute height was in 2009 after the economic crash because we were desperate for money, where it reached 119,000. So there are a ton of reverse mortgages out there. They're more in California than any place else, as we talked about. We lead the way there. And they're just being overused is really what's come down to.
I think we're going to be seeing a lot more of that. I think the current increase in the reverse mortgages is largely because of the equity people have in their homes that's gone up substantially over the last multiple years. And then now on top of that, I believe we're going to have that compounded by the issue that happened last time, which is if we do see a decrease in property values and further inflation and further economic difficulties, people are going to become even more desperate, and they are going to be going to these loan programs that don't necessarily make sense for them, but they're desperate, and so they do it.
Well, one of the ways you can tell that reverse mortgages are in general not a great idea is because of the big four banks, Bank of America, Citi, Chase, and Wells Fargo. If you've been paying any attention to the banking sector in the last 10 years, what you know is what I'm about to tell you is of those four, unfortunately for them, Wells Fargo is the worst of the group. Wells Fargo has been caught stealing money from their clients, opening fake accounts, just literally stealing from their clients. Now, ordinarily what would happen is when a bank behaves badly like that, it becomes a front page story for a week or two, and their stock price is adversely affected, and so they behave themselves. But unfortunately, when a lot of this stuff was still going on, and I contend probably is still going on with Wells Fargo these days, there was something else sucking all the wind out of the media cycle, so none of this stuff really got to the head of it, so it didn't affect their stock price, so they kept doing it. Because one of the things we talk about, I talk about constantly, is what happens when a bank gets caught at doing bad acts is the fine that they take is only a small percentage of the amount that they stole. And I'm going to give you some examples of that before the end of the show today because they're appalling, particularly with Carrington and PHH, because what they get away with is murder. But in Wells Fargo's case, they used to be the big dog in the block when it came to reverse mortgages. They kind of pioneered a lot of what is now the reverse mortgage industry. And yet, in what year you're reading, they got no longer in it?
Yeah, 2011, they became the largest single reverse mortgage lender holding 26% of the loans. And by the next year, they got out of the market.
So what we're saying is this is a type of financial vehicle that, although insanely profitable and really hard to lose money on an individual loan, let alone Wells Fargo, who's already a pretty big offender in this market space, has decided that this is too sleazy for us.
It's bad PR. Reverse mortgages do have a negative rep, and I will say I do want to make it clear I'm not opposed to reverse mortgages. I don't think that they're inherently a bad idea for everybody.
True.
I do think that under certain circumstances it does make the most sense. It's not an awesome loan because of some of the problems you were mentioning.
Sure.
But it does make sense for some people. But I kind of fall back on the advice I would give to anybody getting a loan or participating in any financial transaction. It's just tenfold here, which is you have to educate yourself. You have to know the terms and evaluate it. Sometimes it makes sense. And there are the other variables like the amount of the loan you're taking, whether or not it's fixed rate, whether it's adjustable, what the interest rate is, what the fees are up front. Those can vary wildly depending on the broker you use.
What's your plan? Are you going to be in the house more than 2 or 3 years? You're going to be in the house 5? I mean, you don't know because we're usually dealing with health issues and stuff like that, but usually there's a plan of some sort.
Exactly. And some people are going to focus more on the short term. If you're 90 and taking out a reverse mortgage and, maybe not in great health, but you just need a little extra peace of mind because of the payment there, maybe the interest rate isn't quite as important as keeping the costs down because those can be very high. Weirdly, the interest rate isn't too bad, but the costs going into it and then the overall costs being rolled up.
That's an excellent point. It's a really good example too because we have a client right now who is 90, lovely person. I'm really enjoying working for her, but her taking out a reverse mortgage at 90, I mean, God bless her. I hope she lives to be 110, but the odds are not in her favor. So odds on, I hate to point this out, but she's already beaten the curve. The average American female is to be 88 years old in the United States right now. She's already beaten the curve. Yeah. So if you do the numbers, if you run the numbers with today's interest rates, what you'll find is, so guys who are listening to this, pay attention, is that if you're going to be there for 2 to 3 years or less, a reverse mortgage doesn't typically make sense. You're much better off just taking the money out of your house. Do a refinance, do a home equity line. There are many different ways to achieve the same thing. Now, you may not qualify, you may have no choice, but at least look into these other options because if you're really going to be there for a couple of years, I don't mean alive, I mean in the house, of course alive too, I suppose, it is not a great idea to take out a reverse mortgage. Now, if you're 62 and you're in good health and you're like my mother, your mother-in-law, who's decided to live forever to curse us all, her taking out a reverse mortgage made good sense. Because I promise you, knowing my mom, she is absolutely going to get every penny out of that, and then she's going to find a way to make the bank lose money on it. And God bless her for doing it. I think that's fantastic. So if you're in that position, go for it. But again, think it through. We had a number of conversations in my family about whether this made sense or not. I mean, my mom's going to make up her own mind because she makes up her own mind. But in her case, it made good sense to do it. So, but for most people, you got to weigh the pros and the cons. You got to think if this makes sense to you because sometimes it does, sometimes it doesn't. But you got to get into that. So
I would also, if you don't mind, jump in just for another minute there. I do want to point out that I think sometimes seniors, when they get this advice to, look into it or have somebody come with them to help them with this process, I think they take it personally. They tend to think, well, I'm not stupid. I know how to do this. I've taken out 3 or 4 mortgages in my lifetime. I've done all these transactions. I know what I'm doing. But number one, I would say a reverse mortgage is many times more complicated than a regular mortgage. Yeah. It is an incredibly complex transaction. And the reality is people aren't stupid as they get older by any means, but there are physiological and structural changes to a senior's brain. I read a very interesting study. Well, actually, my dad referred me to it that just says older people, as we get older, our brains lose the ability to be discriminating when we see like a shifty face. They've done studies like this at UCLA. They did one where you're shown pictures of a face that intentionally looks shifty, eyes averted, things that other people and younger people will assess as shifty and untrustworthy. Whereas the senior faces do not recognize that. They are very much more likely to be trusting and to believe what's being told to them. So it means well. I was lucky. I mean, I love that my dad came to me and he said, I read this story. I don't want to be catfished. I don't want to be taken advantage of. Here, I'm going to give you power of attorney. But, that was easy. So we were able to have that conversation. But you have to have conversations with people as they get older and are contemplating these things.
Also, that study that you're quoting is, if listeners, if you don't know, we have a 17-year-old daughter, and she quotes that study to us all the time because she likes to tell us how you're getting older. And no, I really did take out the trash. You just didn't notice. And honestly, she's so good at it that sometimes I'll go, did she? I have to go look out for you to take the trash. I'll go take the trash. Because she's 17 years old, and she, unfortunately, is. I have to just apologize to you because she is. Please take after you, Catherine. If you're listening, please take after your mother more than me, please.
Yeah, she's.
Your life will be easier.
It's not noon yet.
The most common phrase here on my house is "more your mother, less me." Please. I want you to give us a second, and I want you to think about how your mother would react to this, and then I want you to think how I would react to that. Then decide how you want to react. Some people wear those little wristbands that say, "What would Jesus do?" No, in our house, it's "What would your mother do?" Because think about how your mother would handle this. That is how you should do this. Then think about how your dad would handle this and do the opposite. Because I tell her all the time, you are 50% your mother, you're 50% me. That half of you that thinks you can reach the deep end of the pool from the roof, the dumb half of you, that's 100% me. I know exactly what that is. I know why you thought of it. I know why you're going to think of it again. I'm here to tell you, because I got the broken ankles to prove it, you're not making the deep end. And even if you do, it's not laudable. So please listen to your mothers. But in our family, we had a leg up because I do this for a living, and so do you, and so it was very easy for us inside our family, but not everybody has that, so call us.
And even so, I would point out that even though I then got into helping my folks out and taking care of stuff, I found multiple instances where they had paid the mortgage accidentally twice in a given month because they didn't know they had already paid it. They forgot. There were definitely signs that financially, because that's another thing about aging brains, they're not less capable. Or they become a little bit less capable as we grow older. That's just normal. We're not quite as sharp. That happens with age. Not a huge amount, but our confidence level apparently does not go down. So we are just as sure we've got it right when we're becoming a little less capable of it.
See, I think you're talking about me there because you're looking at me and you're saying that. And I want to point out, I want the the listeners to know this. You're older than I am. I don't want to belabor that point because it's not a very gentlemanly thing to do, but I kind of feel like you're smarter than I am. So I feel like when you say you get slower as you, I think you're talking to me, which wouldn't be entirely wrong either. Let's get back on track. So I tell you what, why don't we break we'll go to a break. We'll come back. We'll talk a little bit about a couple of cases we have in the office that are particular. And I really want to talk about Carrington and PHH because they are the biggest offenders in the mortgage market. And if you have these people as your mortgage lender, you didn't choose them because nobody chooses them. We'll talk about how to deal with them when we get back. My name is Rich Sherman. You're listening to The Real Estate Fix with Rich on KHTS 98.1 AM 1220. Let's hear from the advertiser. We'll talk some more about reverse mortgages with Jane when we come back. Hello, welcome back. You've reached The Real Estate Fix with Rich Sherman on KHTS 98.1 FM AM 1220, your hometown station. Thank you for listening to KHTS. We appreciate that. Thank you for listening to the show. We're talking about reverse mortgages. We have my lovely wife and real estate attorney extraordinaire, Jane Sherman, in the booth with us today. And we're talking about reverse mortgages and the pitfalls and the kind of stuff that people get into with reverse mortgages. And I want to talk about some of the stuff that really causes this stuff to go sideways. I want to talk about a couple of cases we have in the office right now because they're exemplary. They exemplify what's going on in the industry in general, particularly with two mortgage companies. One is PHH, and they're they're one of the biggest companies, mortgage companies in the world. They got heavy into reverse mortgages when guys like Wells Fargo decided this is not reputable for us to stay into, no matter how profitable it is. And so PHH, and we also know them by another name, Ocwen. They go by either. Ocwen is the parent company, and they're a horrible company. Again, they steal from old people and then they torture them. I don't know how else to put that because that is what they do. And I will say that out loud until it either stops. And as my attorney is constantly telling me, the truth is defense against libel. And that is the truth. So if PHH and Carrington have a problem with what I'm saying, please sue me. I would love that. Bring it. I would love that. You probably wouldn't like it.
No,
I would love that fight.
Yeah.
Though. I would absolutely love it because they're wrong. I'm right. They're stealing from old people and torturing them, and I'm not. So heck with them. Anyway, so let's just talk about the history of these two banks really quick, and then we'll get into reverse mortgages. We'll talk about PHH first, and this is just recent history. In February 2017, both PHH and Ocwen, which is the same company, received cease and desist orders prohibiting the acquisition of new mortgage servicing rights and the origination of new mortgage loans by either of them until the company was, and I quote, able to prove it can appropriately manage its consumer mortgage escrow accounts. Because in 2017, they were caught stealing from people. You can say there was a math error and we didn't do this. Like Speak Banker, you can make it say anything you want, but the reality is they were stealing from people. So they were said, you're not allowed to do business. They were told, you're not allowed to do business anymore until you stop doing that. So, of course, they promised and got right back into business. That was in February. In August in 2017, same year, PHH paid $74 million to settle bad loan allegations. PHH violated the False Claims Act by knowingly originating and underwriting mortgage loans insured by the U.S. Department of Housing and Urban Development's HUD Federal Housing Administration, guaranteed by the United States Department of Veterans Affairs, because they steal from veterans too, and purchased by the Federal National Mortgage Association, that's Fannie Mae, and the Federal Home Loan Mortgage Corporation, that's Freddie Mac, that did not meet the applicable requirements. That is a very legally nice way of saying they were lying to them and then selling the loans anyway. They were giving people loans who did not qualify, and the loans were going bad. And so FHA and VA and the auspices of Fannie Mae and Freddie Mac said, we're getting way too many of these from one company. I wonder why that is. And they looked into the files they found, because these people shouldn't be getting loans to begin with. That was in August of 2017. So let's jump ahead a little bit. We'll skip, there are plenty in between, but let's skip ahead. February of 2021, a coalition of 33 state attorney generals filed a motion against PHH Mortgage and its predecessor, Ocwen Loan Servicing, for allegedly charging unlawful service fees to nearly 1 million borrowers. And all the stuff I'm going to talk about today with these guys is going to be unlawful servicing fees. That was just February of 2021. So 33 states have sued them, still not enough to get them to stop doing this. July of 2021, just a few months later, a mortgage holder with a defaulted home loan settled a potential class action lawsuit with PHH after he alleged that the company inflated property inspection fees, which is exactly what they're doing to another client of mine. September of 2021, homeowners who filed a class action lawsuit against a Florida mortgage servicer provided pay fees have settled the case for $12.6 million. So PHH paid out $12.6 million. Plaintiff PHH, suing and his parent company Ocwen Loan Servicing, submitted a request for preliminary approval of the proposed settlement on the U.S. District Court in Florida on August 25th. The agreement includes financial compensation and changes in the way the company deals with alternate payment methods. And here's the fun part, and this is the part that's going to make you mad. Central to the case was PHH Mortgage's practice of charging what are referred to as processing fees. And this has to do specifically when people would make their payments over the phone. But they would charge $17.50 roughly for each one of these. They weren't telling people they were charging these on top of everything else. And now here's the part that curls my hair. The proposed settlement sets up the eligible class members, these are the people who sued and fall into the particular years and times, to get a refund, and you ready for this? 18 to 28% of what they were overcharged. So they stole money from their own clients with overcharging, but it's okay, because if you go to them and you're a member of the class, you can get back somewhere between 18 to 28% of the amount they stole from you. So let me see if I get this straight. If I took a car to the closest bank and we robbed them and we stole $100,000, but we only had to give back $18,000 and I don't go to jail.
You do it tomorrow, too.
I'll drive. Let's go. Sounds good to me. All you got to do is be a bank. The best way to rob a bank is to own one. So along with the financial portion of the settlement, and I like this part too, PHH Mortgage Corp has agreed to reduce its online payment fees by 13% and freeze that amount for 3 years because they're responsible corporate citizens.
Yeah.
You're stealing from your own clients, you get caught stealing from your own clients, and your settlement is you only have to pay them 18 to 28% of what you stole? That's a lovely settlement. That makes sense. And that's PHH. Before we go on to getting back into this, let's talk about Carrington a little bit. It's my other favorite offender. Let's talk about Carrington's history, and then you'll know why I hate these people and why I say they steal from old people and torture them. 2022, Carrington was fined $5.25 million from the CFPB, the Consumer Financial Protection Bureau, and you've heard me talk about this before because it's infuriating. Carrington Mortgage has $112 million in mortgages under contract. They are a $100 million company. Fining them $5.25 million means nothing. They were fined for, this is the exact verbiage from the CFPB, misleading certain homeowners who had sought a forbearance under the CARES Act into paying improper late fees, deceive customers about forbearances and repayment options. It says deceived customers right in there. And inaccurately reported forbearance status to borrowers to the big three credit reporting agencies. Carrington also misrepresented the homeowners the need to provide specific reasons in order to obtain a forbearance when they did not. CFPB ordered Carrington to repay any late fees not already refunded, repair its faulty business practices, which it has not done, and pay $5.25 million in penalty that deposited into the CFPB's Victims Fund. The no less a character than the head of the CFPB, Rohit Chopra, said, and this is a direct quote, Carrington Mortgage unlawfully withheld legally mandated pandemic protections, wrongfully imposed fees, and reported false information to credit reporting companies. Homeowners were misled and denied key protections at a time when they were in the most need of help. And just to get caught up with Carrington, because that was November of 22, in May of this year, they paid $18 million in a settlement doing with overcharging of fees. Convenience fees of $5 to $20, same story as with PHH. Plaintiffs in California, New York, Texas, Florida, and Maryland all alleged that the practice of doing this is an overcharge when they weren't allowed to do that. So same thing with Carrington. They settled for $18,181,898.95. I like the 95 cents. That's really nice. Which represented 35% of the total convenience fees they charged. So they prepaid 35%. They needed better attorneys. PHH got a better deal.
Yeah.
But 35% when you steal from people, you only have to repay 35%. Nobody goes to jail is obscene. But wait, it's okay because Carrington is prohibited from charging these customers or any of these sorts of fees for a period of 3 years. The same magic 3 years the PHA settled for. So 3 years from now, they can go back to doing that. And I like this one too. The court observed in the final approval order that, because the court had to approve this, Carrington was earning nearly $8 million per year from these fees, from the illegal portion of the fees. So they're stealing $8 million a year that they've been caught stealing. My supposition is it's a lot more than that. They're caught stealing $8 million in fees, and they only have to repay 35% of that. So they only have to pay back $2.8 million, something like that. That is obscene.
Not much of a penalty.
I hate these people. I hate them with an all-consuming passion. And this is the kind of stuff. Why? The oversight is so poor. That's why they keep doing it. Neither PHH nor Carrington has changed one thing about their business practice that led to this. Maybe they've gotten a little smarter so they get caught for exactly, but it's exactly what they're doing. So let's talk about what these are doing to some of our clients and how this sort of thing is manifesting itself in the mortgage industry, in the reverse mortgage industry. So first of all, let's talk about what ordinarily sets a reverse mortgage into foreclosure. What is the most common reason that a reverse mortgage winds up going into foreclosure? Because obviously you're not making payments.
No, I don't know the numbers on it, but I know, and in some cases they describe it as foreclosure. It's when the borrower or borrowers, if you've got one or both spouses, leave the home permanently or for more than 12 months. Mm-hmm. And then I believe they consider it a foreclosure, even though it's not. It's that you're not complying with one of the terms of the loan, which is that it be the primary residence of the borrowers. But beyond that, the two biggest ones, actually really probably the biggest one, property taxes. A lot of people don't seem to know that they are responsible still for property taxes and insurance. And if they fall behind on that, that becomes a reason for the bank to foreclose.
Yeah, well, those are the three biggies: property insurance, property taxes. And you can have both insurance and property taxes impounded as part of the loan. They'll take money and they'll set aside, but most people don't. It is extraordinarily rare in my experience.
Yeah, it's not very common, and most people just don't know it. It's kind of like what you're talking about. The banks have so much power and so much clout to get away with everything that you have to have people in your corner and you have to understand what you're doing. Yeah.
But the big one is certification, because they want you to prove, although the law doesn't say you have to, it just says you have to be in the house, right?
Yeah. One of the things you typically yearly will sign a document, something called a declaration of occupancy or something like that the bank sends you, because the requirement is that you live in the house. But a lot of people don't necessarily open their mail or respond the way they
Here's
should.
an example from a client living in Candy Country right now. She's 90 years old. She got a letter in the mail from a company she had never heard from. She ignored it because she thought it was an advertisement. Turns out what that was is Carrington telling her that they have taken over her mortgage and they want to know if she's still alive and living in the house. And because she didn't know that that's what that was, and she didn't tell Carrington that she was both alive and living in the house, Carrington decided, didn't send anybody out there, didn't make a phone call, although her number's publicly listed, didn't do anything.
They are supposed to, and supposedly
I know they're supposed to
do a lot of additional work to confirm that. But
no, they don't. What they did is they put her in foreclosure. Now, that was bad enough. So we proved that she's alive. We're getting her out of foreclosure. That's simple enough. But they have charged her in excess of $4,000 in, excuse my language, but BS fees. Her house has been appraised 3 times in 3 months. There is no requirement that you appraise a house that often.
And she's paying for each one of those.
Not only that, they're charging her $700 a pop for something that doesn't need to get done.
This is why, if you know it up front, because once you've gotten into that trouble and you've not paid the fees and you have these additional expenses on there, it is next to impossible to change that. So knowledge going in is key.
Let me also point out that I don't think these inspections were never done. These appraisals were never done, because when you are a consumer and a bank does an appraisal or does any sort of a report on your home and they charge you for it, you have a right to the report. We have asked Carrington for the 3 reports and property preservation, all of the things they're supposedly doing. They will not produce a single thing. Nothing. Because they don't exist. Because they charge these people, they charge this client about $3,000, $4,000 in overages. And how would you know?
Yeah.
I know what I'm doing. You know what we're doing. We do this all day, every day. I had to dive into her file. It took me 3 weeks of daily work on her file to figure out what was going on because they make it that convoluted. They also even tell you what the charges are. They use codes, and when you ask them for the codes, they won't give them to you. They'll tell you they're proprietary, so I can't know what it is. The client can't. That's obscene. So that's the kind of stuff we see. I just we're getting ready to wrap up the show, but this is the kind of stuff that we see on a regular basis, and it is really aggravating. And I apologize if I lost my temper, but I get really mad when companies like PHH or Carrington steal from the elderly and then torture them by threatening with foreclosure if you pay up. It's an extortion scheme. It's awful and it's wrong. That's the bad news. The good news is, and we'll try to calm down a little, the good news is that we stand in opposition to that. We can fix that. You don't have to go into these battles alone. We can help you.
Yeah.
So my office, that's why we have Jane as an attorney. She volunteers to help with this all the time. We do it for free. We'll help you out for free. Call us anytime. If you have questions about a reverse mortgage, if you have problems with a reverse mortgage or any kind of mortgage, any kind of real estate issue, if you have questions, you have problems, give us a call. We can help you out. You can reach me. I'll just give you my personal cell phone number, 661-714-1400. That's my personal cell phone. You can reach me at that number 24 hours a day, 7 days a week. You can text too. And I will call you back and we'll fix your problem. That's what I do. So thank you guys for listening. I really appreciate it. It's been a great show. Thank you, honey, for coming in and helping out. I really appreciate it. I like it when you come in. It's just nice to have you here. Plus, people think I'm smarter when I stand next to you. So I like that. Thank you. We'll have another. We'll see. Maybe I'll have to come back next week. I'll ask nicely. We'll see. We'll see what happens next week. We'll say I got a bargain for these things. But anyway, thank you guys for listening. I'm Rich Sherman. You've been listening to The Real Estate Fix on KHTS 98.1 FM, AM 1220. If you have questions about real estate, you got problems with real estate, whatever your questions or problems are, call me anytime, 24 hours a day. Please think of me as a resource. I will fix your problems. I'm Rich Sherman. Have a great week.